Hello everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host as always, Stan McCune, realtor right here in the Greenville area. You can find all of my contact information in the show notes if you need to reach out to me for any of your real estate needs. That's the only way I make money through this podcast is through you, my potential clients, former clients, current clients, referrers of clients, all of those things. And even if you're just a listener, there's a way that you can support the show beyond just referring business to me. And that is by subscribing, by liking, by hitting whatever button you can that can support the show. Different apps, different platforms have the ability to comment or like or leave a rating or leave a review. Whatever app you're using, please go ahead and do that. I would greatly appreciate that from all of you. Today we're going to be taking a look at how mortgage rates impact buyer demand. So we know that rates going up, when the 30-year fixed rate mortgage goes up, demand goes down. And when the 30-year fixed rate mortgage goes down, when rates are low, demand obviously picks up. People are sensitive to those rates. When we had rates at all-time lows during 2020, 2021, demand went crazy. Now that rates have been at higher levels, the highest levels that they've been in 20, 30 years, that has cooled off buyer demand. So I wanted to take a deeper dive into this and see what exactly is the impact that rates are having in general. And I wasn't really sure the best way to do this for the purposes of the show, but basically I did a bunch of analysis. And at the end of the day, I'm going to be showing you a few snippets of the analysis that I did, and then we'll go ahead and draw some conclusions on the basis of that analysis. Now, if you're watching on YouTube, the show is on YouTube. I am going to go ahead and screen share. All that I'm going to be screen sharing is the Federal Reserve's data on the 30-year fixed rate mortgage. So what you're going to be seeing is the actual data. Let me make sure I'm actually sharing the right thing here. Okay. There we go. If you were watching on YouTube, you may have not seen anything change, but something changed on my end. That's the only thing that matters. Okay. So you're going to be seeing basically from 2019 through the present what the 30-year fixed rate mortgage has done. But if you're just listening, no worries. You'll be able to track everything just fine. Just know there is a lot of data that we're going to be covering in here. And again, I'm going to do the best that I can portraying this data. But if you have any questions, you guys know my contact information is in the show notes for any questions that you might have. All right, we're going to dial back the clock to 2019, specifically to June of 2019. So for those of you that don't remember, 2019 was an interesting year. That was obviously right before the pandemic. And rates were doing some interesting things. We had rates go up near the fives towards the end of 2018. And then going into 2019, we really did not know what was going to happen. And what ended up happening is rates started to go down a bit during the year 2019. Now, before I get too ahead of myself here, I want to clarify one thing. I don't know why, but for whatever reason, the Fed's tool that shows 30-year fixed rate mortgages, it's always a little bit lower than it should be for whatever reason. I don't know. But if in case you're like, oh man, those rates sound really low in comparison to what the market was, they're always a tad bit lower, I feel like, than what they actually were. But I want to dial the clock back to June 2019 specifically, and have us take a look at that. In June 2019, rates were in the high threes. We've got a reading June 6th, 3.82, June 13th, 3.82, June 20th, 3.84. So they were hovering, June 27th, 3.73. So they were hovering right in that 3.7, 3.8 range. And here's what that meant for Greenville demand. We're going to be looking at basically a bunch of different months here. What the rate was, what the 30-year fixed rate mortgage was what pendings were. In other words, pendings are homes that are under contract during that period of time, that went under contract during that period of time, and then how many sold during that month as well. So we're going to start here with this June 2019 with rates in the high threes. Pendings at that time were for the month of June, we had 1,288 pendings in, according to the Greenville, Greater Greenville Association of Realtors market stats. 1,288 homes went under contract, were pending during that time. That was a 2% year-on-year increase, a pretty standard number by that time period. And 1,399 homes sold that month. That was also a roughly 2% year-on-year increase. Okay, that's going to be our baseline. Okay, we're also going to look at September of 2019 because rates started to fall. They kept falling during that time, and they reached kind of their bottom, their pre-pandemic bottom in September 5th specifically, when they hit 3.49. So they've been in their mid threes, and this is the lowest. September 2019 was the lowest that rates had been since 2017. Important detail. Pendings for that month jumped up. They went 18% year on year for September 2019. It's hard to know exactly whether that was because rates went down. I think it probably played a factor, but pendings were at 1,193, which was an 18% year-on-year increase, big increase for that period of time. Solds were 1,296. That was a 22% year-on-year increase. Now, solds lag, right? So obviously a home that went under contract in September most likely didn't actually sell during the month of September. Usually they sell a month or two after they went under contract. But again, we're just kind of establishing a baseline. All right, so let's jump ahead. That was September of 2019. Rates were in their mid threes, the lowest since 2017. Pendings were up and right around 1,200. Solds were up right around 1,300. Those were both big numbers for back then. Let's jump ahead to September 2020. This is when we see rates, 30-year rates, start to go into the twos. So now we're seeing actually a big decrease from what they had been. And right now, they're at historically the lowest that they've ever been. They had never been in the high twos ever in the history of the 30-year fixed rate mortgage. They had never been in the high twos. How did that impact things in September of 2020 versus September 2019? Pendings went all the way up from 1,193 to 1,554. That's a 30% year-on-year increase. And remember that September 2019 was a big increase versus the September before. So that's a really big increase. Solds were at 1,584, a 22% increase year-on-year versus the 1,296 sold print that we had in September 2019. Okay, so we saw basically a 20 to 30% increase in buyer demand when rates went from the mid threes to the high twos. Big increase. Let's skip ahead a couple of months to December of 2020. Here's where rates really bottomed out. Okay, so for the first time, this is the lowest all time we see rates in December of 2020. They're in the mid twos for a 30-year rate. I had some clients that bought homes during that period of time. They're very happy with the rate that they have, let me tell you. Pendings for that month were also, again, up 30% year on year, 1,111 pendings for December 2020. Now, if that sounds low compared to the numbers we've been saying, that's only because of seasonality, right? December is not seasonally a very big month. So the fact that we had, oftentimes, let me put that in context. Oftentimes historically, December's pendings have been below 1,000. Okay, so for it to be at over 1,100 was a big number. 30% increase year on year. Closings were up 20% year on year. 1,442. Massive numbers for December 2020. Obviously, a huge impact that those historically low rates caused. But again, this is during the slow time of the year. So guess what happened? Rates started to creep up a little bit as we start entering the busy time of the year. And by the time we hit March, right? So the busy time of the year for real estate tends to be, usually it hits around mid-ish February, something like that. Continues on through, perhaps late April, early May, something like that. And then basically we still have a continued busy season for the summer, but not the peak season. So March is really peak season for real estate, at least from the standpoint of me as a realtor. And so in March 2021, we have rates still very low, but not at their lowest point. So that by this point, they've creeped up into the low threes. And that's actually, interestingly, if you're looking at this, that's the highest number for the entire year, is that low threes, because the year 2021 was just insane. So rates are in the low threes, and but they're still half a point lower than they were in March 2020. So if we go back to March 2020, they were at 3.65% at one point, and then in March 2021, the highest point they reached is 3.17%. So basically half a percent lower than March 2020. Of course, we can't really compare anything to March 2020 because that was when lockdown started for the pandemic. We don't want to talk about that. But what happened so this is the first time. The point of what I'm trying to set the stage for is this is the first time that we've had these rates basically right near 3% during a peak season. What happened? Things went bonkers. Pendings went to 1,678. I think that was the highest number ever. Up 34% year on year in comparison again to March 2020, which is a bit of an anomaly because that's when lockdown started. But prior to that, things had been strong prior to lockdowns. Solds 1,521. That was up 14% year on year. So what we saw is a huge increase in demand as a result of these low rates. Not surprising. Now, a little bit of narrative here. After the spring peak season, we see a slowdown in numbers into the summer months, okay? So even though rates did basically go to their highest point of the year in March, we saw the normal seasonal slowdown that happened once we hit the summer months. And the result was that we saw numbers that came in year on year slightly less than 2020, even though mortgage rates basically stayed roughly the same for that period of time. Why were the numbers lower than 2020? Okay, we're talking about the summer months. A couple of reasons, I think. First, inventory disappeared. All of the excess inventory got eaten up. We went down to 1 month or less of inventory. Historically, the lowest numbers that we've ever seen in terms of homes available for sale for the average home buyer. And so inventory just disappeared. People there weren't enough homes to purchase, enough homes on the market for transactions to happen because everything had been gobbled up by that point. And so even though there was probably more demand than is reflected in the numbers, the demand couldn't keep up, or the supply couldn't keep up with the demand. So there just weren't enough houses to transact during that period of time. And then as an addition to that, when we're comparing to some of these 2020 numbers, it is important to remember that there was about 6 weeks of very little real estate transactions in 2020 as a result of the lockdowns that happened. And so that 6 weeks of demand basically got spread out throughout the rest of the 2020 year, resulting in some of the comparisons of 21 to 2020 not being perfectly apples to apples. But you know what? None of this data is going to be perfect apples to apples because we're in unprecedented times. Everyone always says that, but it is really true. We have never seen rates go up. And if you're looking at the chart, it's crazy how much rates went up. Mortgage rates have never gone up as quickly as they had from 2022 until where they are now. They went up faster than any other level. All right. All of that to be said, there were 2 months in 2021 where even after that peak season, when 2021 clearly outdid 2020, and those were October and November of that year. And again, mortgage rates aren't doing anything too crazy. October, we're seeing rates in the low threes, and that's actually higher than what it had been during the summer. And same thing for November. Basically, we're just hovering around the low threes during that period of time. But during that time, pendings, homes that went under contract in October were up 12% year on year, 1,544. November, up 12% year on year, 1,355. Sold houses, solds in October were down 5%. But again, that's because of the weak summer numbers as a result of the low inventory that happened. Solds in November then went up 17% year on year to 1,461. So even though rates went up slightly, right, they had been according to this data, they had been in the high twos, and then they went into the low threes. Even though rates went up just a little bit, activity demand still was strong. And I think that this is really, really important. There's not always a one-to-one correlation between rates going up and demand going down, or rates going down and demand going up. There's more things at play here, particularly when the increase or decrease in rates is minor. And by minor, I mean a half a point or less of an increase or a decrease. And I think there's a few reasons why we saw high numbers in October, November of 2021. I think one thing, maybe people hearing the news, they were worried that rates were going to go up. And if you're looking at the chart, they did go up right after this period of time. But I think a lot of this is also just the result of kind of an anomaly, a random thing that happened in the market, which was, I think, probably all those people that couldn't buy during the spring and summer frenzy of 2021. They found that there was a little bit less competition in the fall. And so then they all kind of came back online during the fall and fourth quarter of that year, with the result of the fourth quarter numbers being kind of unusually high by Greenville standards. So that's something to keep in mind, but I wanted to set the stage again that it's not a perfect one-to-one correlation between rates and demand, okay? So here's what we can conclude so far, besides what I've already said. Rates dropping from the mid to high threes to the mid to high twos resulted in a massive increase in demand, something like a 20 to 30% increase in demand. Now, again, the tricky thing with this is that there was that 6 weeks of demand that got spread out throughout 2020, so it's not perfect. These numbers aren't perfect, but best we can see, there was something like a 20 to 30% increase in demand. If you want to be more conservative, say maybe a 15% increase in demand. I'm not going to fault you for that. Again, because we're comparing to an imperfect environment, but that's roughly speaking what we're talking about. When rates bounced back up into the low threes, it didn't have a big impact at the end of the day. Numbers were generally less than they had been before, but some of that can be attributed again to the 6 weeks loss during the pandemic of 2020. Rates at this level were still well below all historical norms. But what about when rates start climbing? February 2022 marks a very important month, okay? Because that's when rates started to climb above pre-pandemic levels. So we can see if we're looking at the Fed's chart, December, the end of the year, 2021, was kind of the last time that we see rates in these historically low numbers. December 30th, we have a print of 3.11 for the 30-year fixed rate, and then it just starts to go up. By the time we get to February, we're already in the mid-threes, and by mid-February, we're already above where we were pre-pandemic, okay? February 17th, we have a number of 30-year fixed rate mortgage average of 3.92. That's the highest that we've seen since, let's go back here, May 30th of 2019. So that's a long time. That's a long time that you have to go back. And so what was happening in February of 2022? Rates hit the high threes for the first time since 2019. Pendings, 1,359, down 4%. Solds, 1,162, up 9%. Okay? Now, I'll get to this in just a second. We'll come back to that, why solds were up even though pendings were down. March 2022, we have rates that went slightly down. They went into the mid to high threes eventually, and then eventually by the end of March, they're already in the mid fours. So what happened in March? Pendings 1,570, high number, but still down 6% year on year. Solds 1,544. That was up just 1% year on year. Let's go ahead to May 2022. May, now we see rates in the fives, in the low fives. Pendings now 1,482. That's down 12%. Okay, you see what's happening? February pendings were down 4% year on year. March down 6%. May down 12%. The numbers are getting higher. What about solds? 1,578. That was up 4%. But remember, we're comparing against the low inventory numbers of 2021 that kind of artificially depressed some of the numbers in that year. So that's an important detail. Let's jump ahead to June. July, we have basically a little bit of fluctuation in these months between low and high fives, basically, in terms of the 30-year fixed rate. The June-July pending numbers were respectively 1,388 and 1,397. Those are each down 8% year on year. And solds were 1,704 and 1,407. June down 4%, July down 10% year on year. So importantly, these pending numbers are ultimately, they're actually pretty close to the 2019 numbers. So rates going up caused the market to kind of revert back to what the demand was in 2019. Now, closings are still high, and we even had a few of those months where closings, actually out of the 5 months we just went to, 3 of those months, solds were up year on year. And this is the result of just low inventory causing fewer homes to fall out of contract. So we got pendings going down, but solds going up. What bridges the gap between those two is homes that go under contract and then fall out of being under contract. Here's what happens when inventory is really, really low. People are scared. They get something under contract. Listen, I experienced this when I was doing real estate back then. My clients, when they finally got something under contract, they were terrified to lose that. They would do just about anything to get to closing and to not have to go back to, making offers on 15 homes before they finally got one under contract. So even though we saw pendings normalize, closings were still elevated because buyers were not backing out as often as they traditionally do. Now, I don't have any data on this, but I'll say it sure feels like buyers are backing out a lot more than normal right now, the way the market currently is. And this is because they feel like they have more options. They're more concerned about what's happening in the market. And so we're seeing backout rates kind of come back to not just normal, but perhaps even elevated levels. Perhaps that'll be something I'll discuss on another podcast. Okay, let's jump ahead to late 2022, third and fourth quarter 2022. Now we see mortgage rates again make their final leap from basically the high fives into the low sixes. That was September. And then in October, from the high sixes into the low sevens. Okay, so how did the jump in September into the high fives, low sixes impact things? Pendings, 1,263. These are down 14% year on year. Now remember, we had looked at September of 2020. The pendings for that year were 1,554. So it's down a lot since 2020 and down since 2021. October pendings 1,167, down 25% year on year. Remember, October 2021 was 1,544. So a big decrease. Solds 1,468, down 10% for September 22. Solds October 1,232, down 13% year on year. This trend continues. November 2022, when rates were in their high sixes, low sevens, pendings went down 28% year on year, all the way down below 1,000, 984 pendings, 1,200 solds for that month. That was down 18% year on year. December 2022. And we actually saw rates kind of moderate a little bit. They kind of went back into the mid to high sixes during December 2022. Pendings went all the way down to 810, down 25% year on year. Solds down 24% to 1,228 closings year on year. And so mortgage rates obviously had a massive impact on all of this, right? We're seeing exactly what happens as rates go up and down. We talk about how it impacts demand, but I wanted to bring you guys the data and draw a few conclusions from this data. Let me see how far we've been going. All right. Yep. I'm not going to take a whole lot of time going through these conclusions, but I do want to go through this real quick. What can we conclude from this? First, the market is more sensitive to rate drops than to rate increases. Now, the market is we just saw, the market is very sensitive to rate increases, but we saw more of sensitivity when rates went down into the twos than what we saw when rates went up into, say, the fives. And so ultimately, the largest numbers that we discussed on here, remember? The largest number out of all of these was that March 2021 pendings number was up 34% year on year. No other number on here compares. And I didn't just cherry pick numbers. I actually did cherry pick some of these numbers. I tried to pick some of the biggest numbers on here because those were the outliers, and that could kind of tell us, okay, what's happening. There were no decreases in anything that compared to that 34% increase. The largest decrease was the 28% pendings decrease in November of 2022. And again, this is the difference. This is after rates had gone into the sevens in November of 2022 after having been just a year earlier in the threes. So rates more than doubled and pendings went down 28% versus when rates had only gone down in March 2021 versus March 2020 by half a point. Demand shot up 34%. So the market is more sensitive to rate drops than to rate increases. Keep that in mind because there's more consensus that ultimately that we're near the top of where rates are than that where they are currently. Most people think that we're pretty close to where they're going to stop before at some point, who knows when, but at some point rates will come back down. So when rates come back down, you can expect a bit more market sensitivity in terms of demand than when rates have been going up. Secondly, I think the data indicates that there are different levels of rate sensitivities. So we've already discussed this a little bit, but when rates went up in March 2021, that was still a record-breaking year. But rates, again, they had only gone up about a half a point, but that wasn't enough to overcome peak real estate season frenzy. Sorry, I cannot talk right now. The peak frenzy of the real estate season. And so again, some of this matters. Do rates go up or down at what time of the year? That matters. If rates go up during the slow time of the year, during the fourth quarter, for instance, that's going to bring demand way down. And if rates go down during a peak season of the year, that's going to cause demand to go bonkers. That's another thing to keep in mind. We need to track when these rates go up or down. In fact, all the up and downs that we see in this data, through it all, it really seems like the sensitivity, generally speaking, is more at a full point increase or decrease versus a half point increase or decrease. What I mean by that is, so we're right now, as I'm recording this, September 18th, 2023, we are at, last I checked, right around like 7.3 roughly is the 30-year fixed rate mortgage, somewhere in that range. It's up and down all the time. But basically, if that comes down a half a point, I don't see that having a huge impact on things. But if it comes down a full point, when we start to see it down into the low sixes versus merely the high sixes, I think that's going to have a massive impact And we see this all through this data. Again, I only discussed a little bit of the data with you because we just don't have time for it. And discussing so much data, you kind of get overrun with it if you're just listening to it or even just watching it. So I didn't want to go crazy on you guys. But it's all through the data. The half point increases or decreases don't really impact things, but those full point increases or decreases definitely do. And that's when we start to see demand swing one way or the other. So I already kind of jumped ahead here, but with rates hovering in the low to mid sevens right now and having been here for a while, I think we'll continue to just see demand at the levels where it has been, assuming no new major economic event. And of course, I always have to hedge that. Assuming the economy roughly stays the same and rates roughly stay the same, I think demand will roughly stay the same. Nothing groundbreaking. But you hear people all the time, if you go on Twitter and you talk to the doomers on Twitter, they will tell you it's going to crash. Even if rates stay where they are, the market's going to crash. I don't see that in the data, but we'll have to obviously keep tracking. Now, if rates go above 8%, then I think we can expect to see a drop in demand, probably on par 5 to 10%. That's basically what we saw in this data. When rates would make a jump one way or the other, or a decrease by 1%, we would see demand swing 5 to 10%. And if rates went above 8%, I think we would see a loss of about 5 to 10% of demand. And that would probably be enough for us to start seeing prices going down on a year-on-year basis. I've already said we might have a few year-on-year prints that are down before the end of this year. We had one already. We might see a couple more. But I think if rates went above 8%, I think we would probably see an extended period of time until those rates went down, where we'd see prices on a year-on-year basis lower. Now, if we saw the opposite, what if rates dropped and went then into the low sixes? Then I think we would see demand increase by 5 to 10%. We would start to see prices increase meaningfully. Real estate prices right now are basically staying flat year on year. We're seeing, 1%, less than 1%, a slight below, or a slight decrease in that 1 month that I mentioned. But if rates dropped into the low sixes, we would start to see those year-on-year median sales price numbers that we look at so closely, start to see those to creep up from where they're hovering around like 1-ish%, probably start to creep up to 2, 3, 4, 5% year-on-year, because that demand would impact things pretty big. Now, it's hard to really quantify how many... with all the different factors that there are at play, because like I said, it does matter what part of the year these rates go up or down in. But generally speaking, if you see a rate increase or decrease by a full percentage point, that's when you start to see demand increase or decrease by roughly 5 to 10%. I've said it on this show, and I will say it again. There is a lot of data that indicates that at 5.25% for the 30-year fixed rate mortgage, and below that number is where the market would start to go bonkers again. I think until we hit the low fives, I think the market will be relatively tame. I say relatively because if we see them go into the low sixes or high fives at some point soon, we are going to see that big. A 5 to 10% increase in demand would be big. But it would be really crazy if rates went even lower than that. I don't see that happening anytime soon, okay? We've talked about this before. The Fed seems pretty, particularly with unemployment not getting very high, there's a lot of angst over inflation at the Fed. I think the Fed is going to kind of hold the line for a bit in terms of interest rates, which then impact mortgage rates. So I'm not predicting that we're hitting 5.25% anytime soon. I'm just reminding you guys that's kind of a line in the sand that I think is real. And I think it's reasonable to assume when rates do fall back to that level, maybe we're talking about It might be over a year from now. We might be talking about in 2025 before that happens again, because that's a full 2 points below where we are right now. So it would take a lot of rate decreases theoretically for the Fed to do that. I know that there's, people like to talk about the spread between the 10-year Treasury and the 30-year fixed rate is abnormally high right now. I understand all of that, but at the moment, I don't see that normalizing. For those of you that are data junkies and understand what I'm talking about, I don't see that normalizing just yet. So I think it would take a bit for us to go down into the low fives. And I think the Fed doesn't want mortgage rates to go down into the low fives anytime soon. They don't like how expensive housing has gotten the past 2 years, because guess what? It's their fault. It's their fault for this, right? In a lot of ways, they caused it by letting rates go so low. So they feel, sorry to yell into my microphone, they feel responsible. They won't admit that, but I think they do. And so they're going to do their best to keep these mortgage rates elevated as long as the housing market doesn't crash. And right now it doesn't appear like it's going to crash anytime soon. So I think it's reasonable to assume when rates go back to that level again, maybe in a couple of years, that demand would be 15 to 20% greater than it is right now. And at that point, I think it's very reasonable to assume we'd start to see year-on-year price increases in the double digits again, 10%, appreciation for housing going back to 10%, perhaps even higher. So we'll have to see. We'll have to see when this happens. The best case scenario, really, in my opinion, is if when the Fed starts tapering these rates, that they do it slowly, and ideally that they do it during the non-peak season, right? Because again, we're talking about when rates are lower during peak season, things go crazy. But for now, we have a slower period with rates that appear like they will be elevated for at the very least the next half year or so, here in this level, low sevens, high sixes maybe. I think they're probably going to be in the low sevens for a minute. So we'll have to keep tracking that. But long story short is there is some insane rate sensitivity right now market-wide. This is not just in Greenville. I talk to people in other markets. Same thing, but this is a Greenville podcast. So I wanted to bring you the data on Greenville so that you guys got it understood exactly what is happening, what the impact is with what's happening. When the Fed met last week or last month in Jackson Hole, the Fed releasing more, what they're going to do in terms of their rates this week. These things that are happening behind closed doors impact things here in Greenville. And so you heard it here. You got the information for me. I hope that was helpful for you guys. And I hope that if you're a buyer or a seller in the real estate market, hopefully that helps you to better prepare, better plan ahead for what might be happening here in the future. Thank you guys for listening. My contact information is in the show notes. If you need a realtor for any of your real estate needs here in Greenville, we also have a referrals, relocations department with my company. I can find you a realtor anywhere in the country, and we're international, so even outside the country. So let me know if you need that. Please rate, review, subscribe, do all of those great things to support the show, and we will talk again next time.